Hi everyone, I'm Neil Harding.
I'm Mark Ashworth and welcome back to Property Insight.
Today we're going to be talking about a housing market update. So all things housing market, what's going on with house prices, what's going on with the Bank of England interest rate, what's happening with mortgage products. So we've been doing some research for you and dug out some numbers from various sources, including Office for National Statistics, media in the Times, BBC, pulled some facts and figures together which we want to share with you, which hopefully will help us all make sense of what on earth is going on out there right now in the housing market. So to kick us off, talk about house prices. Everyone loves to talk about house prices down the pub.
And here.
And here. So house prices, it's an interesting one really, because depending on which set of statistics you look at, you get a different story. So a great example of that is if you look at the Halifax published data, Halifax states that average house prices are currently £286,000 in the UK, versus a year ago of around £294,000, which is down about 2.7%. Okay, and when we compare that to the ONS data that was released to June 23 for the UK that showed average house prices of £288,000, so a very similar sort of number, but that's actually £5,000 higher than a year ago, showing a 1.7% increase in house prices. So it's quite difficult to know exactly who to believe sometimes.
Yeah, I think it's probably something to do with this fundamental word, which is average. So the UK doesn't really operate in the housing world and the housing market. It doesn't really operate on an average basis. It's very regionalised. So information like this, when it's read in the newspaper, when they're appealing to the whole country, sometimes is skewed. So as an investor, I would say that you definitely want to be looking at your local market within your, let's say, 15 mile radius of where you actually are. I mean, where we are, where Niels lives very near Cambridge, I'm like the other side of Cambridge. And Cambridge as a micro economy in the housing market is completely different to where you are in Peterborough, both in the same county, both in Cambridgeshire, but yet completely and utterly different.
Yep.
And that's probably what, I don't know, what is it, 30 miles, 40 miles, is it from Cambridge? Yeah.
Yeah.
So so you definitely need to be looking at your where you're actually investing.
Yeah, that regional variation point is so significant for the property investor, I think. So we dug into some of the ONS data and they do give some split there and analysis by region. Just particularly we looked at England. So within England, the house prices in London, it's quite interesting. In London, house prices decreased by 0.6%. Okay. Whereas every other region within England increased, and every other country within the UK, Scotland, Ireland, Wales, prices increased. So all other regions within England increased. North East increased by 4.8% year on year to June 23. So that's a massive variation. And then obviously even within that, then you've got, there'll be parts of the North East that will have increased by more than 4.8% as well, some less. So these are all averages. So every other region other than London also increased. So London was the only part of England that decreased in house prices. So yeah.
So I think, so is that a question then for us in terms of what we feel? I mean, obviously we can't predict the market. Nobody can. If you listen to anybody that's trying to predict the market, I don't think it's fair for us to do that, because I just think it's, giving potentially false, not information, but kind of like a false impression of what's actually happening. I think it's more important for us to say maybe how we feel about it and what we're doing in our own strategy now. And, is it a right time to buy? So for example, Neil, would you buy now if you didn't have any property now and you were considering buying property? Would you buy? In the current situation where you do have property in a portfolio, would you buy? How are you feeling about the market at the moment? Incidentally, we'll just also, reinforce that it's now August 23 as we speak.
Yeah. Yeah. So I think, in my experience as a property investor, right now it is definitely harder to make deals stack, especially on a single let buy to let. There's no question. Compared with a year ago, 2 years ago, in the last year, say, interest rates have doubled. We'll talk about interest rates a little bit more, but that's probably one of your biggest costs for a leveraged business, which is all my properties are leveraged with mortgage finance from banks, mortgage interest is a big expense. So trying to make a profit on a buy to let is harder. However, if I find a deal and it stacks and it works, I'll do it, and that's always been the case.
So let's just say, okay, so the issue around the numbers is the mortgage interest rate, right? So if you're trying to borrow at 75% loan to value with a 25% deposit, the issue is that the amount of money that's left over after the mortgage has been paid isn't very much. So, and potentially in some cases may not be anything at all, in which case the bank are unlikely to lend at 75%.
Correct.
So if you had the right deal and it was the right property and you felt there was some margin for growth in that, whether you could force some value or something, would you be prepared to invest, let's say, at a 40% deposit with a 60% loan to value?
Yeah, I think I possibly would do. I think you've always got to look at how much money you've got left in your deal, how much of your own cash you've injected, and what you're comfortable at. And I think at a time when interest rates are rising, and if you're a portfolio landlord, so there was two scenarios there. You're talking about one where you perhaps don't have a property at all, and you think about your first one. Otherwise, for us, we're portfolio landlords. We've got property that might be coming up for a remortgage where you're coming off your fixed rate. I think it's a fairly sensible time to have some cash reserves. It's always a sensible time to have some cash reserves, but particularly with an eye on, okay, what properties have I got that are coming up for remortgage over the next, not just 3 months, 6 months, look out to 12 months, 24 months, or even more. I look out 10 years for my business. You've seen my spreadsheets, Mark, and I've shown you my modelling.
Oh, they're thoroughly detailed.
So I know exactly when every property is coming up for remortgage, and what the stress tests are like to be that are applied to those properties, to make sure I know if I do need a cash reserve in the bank at a certain point in time to maybe pay down a little bit on a mortgage in order to remortgage something onto a favourable rate, then I'm planning now for a year or 2 years' time to be able to have that cash available to do that. So that's part, I think, of what a portfolio landlord, experienced landlord should be doing, needs to be doing. If you're a first-time buyer, then property investing is a long-term investment strategy, and it still is for me, and I think should be for any property investor. So if you're looking at your first buy-to-let right now, and you're thinking, can I make this work? The numbers need to stack up, and stress test, your own stress test. We've done a separate video on stress tests and how they be applied. Apply your own stress tests, not just the banks. Apply your own affordability for your own measures and what you're comfortable with. If it works and you're comfortable with it as a long-term investment, then great. And if it doesn't, don't do it.
So I think last week or the week before, you'll see it on the channel if you have a look for it, we did a video on goals. And I think the answer to the question about whether you should do something now or not really depends on what your goals are and what you're intending. So your position may be different if you've got a professional job or you own your own business, and you want to invest in property in some shape or form. Your strategy may be different to the next person. And so therefore, I think really the question that I'd like to answer, which is now a good time to buy investment property? I would say it is. And the reason why I think it is because Neil's highlighted the fact that the house prices have gone down 2.7% according to Halifax, was it?
Halifax, 2.7%
in the last
down.
12 months, but ONS say it's gone up.
1.7%.
Well, I think it depends on your region, and I would definitely check your region. But I would hazard a guess that it's likely that in most areas the prices would have dropped slightly, if not stayed the same. Obviously, given that everything else in the current economic climate is going up, then because of inflation means that you've got this kind of natural kind of discount being built in, which isn't really spoken of much. And I would say it's a long-term play. So if there are many people who are not able to buy at the moment and house prices are going down, i.e. it's a buyer's market, you said yourself one of your estate agents told you that it was a buyer's market at the moment, I would say that however you're buying that property, whether it's with a mortgage or not, it's a good time to buy property. So you might be in a situation where you can afford to buy property without a mortgage and maybe mortgage it when the interest rate gets better. The point is, chances are you may be buying that property at a discount now to what it's going to be worth in the next few years, because inflation is still going to remain reasonably high until they get it under control. When inflation's under control, they might then bring interest rates down, in which case then people will start buying again and house prices will go up. So nobody knows when the bottom of the market is, but we do know that the housing market has definitely been suppressed over the last few months. It's just your risk as to when you think it's suppressed at its lower level. I think there's probably got a bit more to go. I don't think it's going to go down massively. And the reason why I don't think it's going to go down massively is because we've got this level of inflation, which is essentially making it naturally come lower without it actually moving down on a percentage basis by looking at the year figures. Does that make sense? So yeah, what's the level of inflation been over the last 12 months on average?
Yeah, I mean, inflation, double digit sort of stuff, isn't it? I mean, inflation in the BBC this month, actually, August 23, there's an article in the BBC about inflation, how it impacts house prices, but also wage inflation. So, wage inflation is running, according to that article, in and around 7% year on year. So in a scenario where house prices are, let's just say they're roughly flat, maybe it's minus 2%, maybe it's plus 2%, but it's probably in that range, and that's a national average. If you sort of transpose that over 7% wage inflation, well then what's happening there is you've got the multiple of earnings for people to afford the average house price in the country is coming down. So it's reduced from roughly 7.3 times average earnings to 6.7 in the last year. So another year of that, and it becomes even more affordable. Eventually, it's going to meet some resistance where, despite interest rate increases, affordability is more. Well, things are more and more affordable again, and despite higher interest rates, people can afford to buy property, and that perhaps then finds some resistance for house prices, which then they go up again. And on the subject of interest rates, we can probably talk a little bit about that because we found some interesting information on that as well. So at the time of recording, so current base rate, Bank of England base rate's 5.25%. That's off the back of 14 consecutive increases, which is incredible. Every one of those, apart from one, had been 0.25%. I think the last one, took a few people by surprise and was a 0.5% increase. And that increase to 5.25% that's the highest rate since 2008. So that's quite a long time. And Mark and I saw an article in the Times newspaper dated 23rd of August 23. And just going to read out a short extract from that. So market expects a peak of 5.75% Bank of England base rate in spring 2024, before falling just below 4% over the next 5 years. Okay, so keeping that in mind and thinking about what that might mean for mortgage products and what the interest rates on mortgages are going to do, and I know mortgages are priced in different ways depending on 2-year and 5-year fixed, but they do have an impact, especially on 2-year fixes. So let's just talk a little bit about the mortgage market. So I can talk a little bit about a mortgage that I'm applying for just at the moment. So that's a 5-year fix at 5.89%. Okay. Not an amazing rate by any means, and certainly not as good as what I was seeing a year ago. But one of the things that is quite good about a 5-year fix, which we've done a video separately on this as well, and the application of stress tests, there's different rules that are applied for stress tests and rental and affordability for 2-year versus 5-year, and they tend to be more flexible on 5 years. So for this particular remortgage, for me, this was a better option. And interestingly, the product fee on this was, I think it was in and around 2% product fee, which is nowhere near as bad as some of the huge product fees we've seen recently. So the residential average, again, according to BBC, residential average 2-year fix is currently standing at 6.74%, and the average 5-year fix is 6.22%. So these are much higher numbers that we are used to. I know I'm still paying way less than that on my main residential mortgage, and I'm still fixed for a few years to come, and I think I'm paying 2% or something, which is something I fixed 2 years ago on a 5-year.
Same here.
So it's going to be, I think there's a number of people that are coming off those rates on their own main resi mortgage, which might have a shock in a year, 2-3 years to come. But that's always, that sort of increase is an indicator, I think, of the direction of travel of what mortgage rates are doing. And obviously in the buy-to-let world, whether that's buy-to-let in your direct name or in a limited company, rates are more expensive. There's no question about it. How are you finding the market at the moment, Mark?
Rates for mortgages are difficult. What they're tending to do is they're tending to give a more attractive interest rate on the product in order to make sure that the stress testing allows there to be enough margin from the rental income to be able to afford to pay that rent, and giving them some wriggle room, because the FCA or whoever it is that introduced the new rules on responsible lending means that they have to meet some stress testing. It's either 1.25 or 1.45 time multiple of the mortgage interest repayment, and that has to be what the rental income is, right? I think it depends on whether you're running them personally or whether in a limited company.
Yeah.
And so what the lenders are doing is that they're just basically loading what they would have ordinarily made on their mortgage by loading the product fee. So we've seen product fees go from 1%, maybe 2% at tops, going from 4 to 5%. And then what they do is they add that product fee to the loan, so they get their money in the end. But what happens is that the monthly repayment is lower, so therefore it makes it more affordable. So in my opinion, if you're doing a 2-year fix but you're loading a product fee at like 4 or 5%, there is an option to just stay on the variable rate and ride out a very expensive mortgage for a year, maybe 18 months, and then decide to come off that and remortgage in the future, because ultimately it's going to cost you about the same, apart from the fact that you'll lose a bit of monthly cash flow. But the actual money that's costing you pound for pound at the end of the deal is pretty much the same. It gives you a bit more flexibility. So that's kind of where I am a little bit at the moment with it. And also, I just want to sort of probably just add in a little bit extra, which is to say that when I first had a property to rent, my goals and my reason for having that property were very different to what I do now. And that was that I wanted to invest in property. I wanted to invest it from a long-term retirement point of view. And so therefore the monthly income wasn't important to me. What was important to me was the asset, and to keep the asset and to watch it grow over time. So this was back in 2006 when the interest rate was pretty much about what it is now, between 5 and 6%. Obviously we were coming into a period where everything was going to go belly up. But the interesting point was that there weren't any stress tests back then. And I seem to remember the rental amount being around about £600 and the mortgage being about 550. So, and I still own that property today. It's more than doubled in value. And for the last 10 years at least, I've had a very healthy cash flow from it. It's gone a bit more the other way now. But the rental market and the rental amount has gone up. Probably I'd say it's doubled as well, the rental amount. And so therefore it continues to be a good investment for me. But the reason why I had that was different. So I think I'd like to reiterate that, it's all a personal thing. When someone says, oh, you don't want to buy a property in this market, or you should be buying property or investing somewhere else, or it's, the market's going to crash, or it's the top of the market. It really, that noise is just literally noise. And for most people, it's probably people telling them that have got no experience. So, it really is important to analyse why you're doing it. And, obviously you need to protect yourself. So you don't want to be doing stuff which is unaffordable but I think these days it's pretty difficult to do that, isn't it?
Harder.
Especially if you're buying on a mortgage.
Yeah, much harder to, I think.
Yeah. So, it's, I think a lot of the information and also the way the information and the data in particular is interpreted. So here we've given you a couple of examples of the way that data has been presented, and then they're influencing the readers by framing it in such a way that kind of suits the narrative. Very good. BBC are quite good at doing that, aren't they?
Yeah, yeah. I think
so I think there's also a little bit to be said about that as well. So, you know, have conversations with your professionals, with your mortgage broker, with your estate agent. Find out exactly what the numbers are for a particular property in a particular area, one that you may want to invest in, and see whether it stacks for you. I think there's a lot to be said for that, because one property in the whole country or 20 properties within the whole country is really such a small micro amount that when people talk about these average figures, I think it can skew your mindset a little bit.
Yeah, completely agreed. Yeah, okay. So I suppose, closing remark, no one has a crystal ball. If people are telling you that they can predict the market, they're probably at least partially deluded. Invest for long term. Which is really important with all property investing, we believe. But hopefully some of that information has been of insight for you. We hope you've enjoyed it, and see you next time.
So we look forward to catching up with you on the next one.